Welcome to this explainer on the high cost of living, where we're going to decode exactly what's happening with inflation and interest rates. If you've been staring at your bank account lately, just wondering what on earth is going on with the economy, well, you are in exactly the right place. Today, we're stripping away all that confusing financial jargon to break down the actual mechanics driving the prices we're all dealing with, relying strictly on the data. So let's jump right in.
Ever feel like your money just disappears? It's a horrible sinking feeling, isn't it? You get paid, you manage your usual expenses, and suddenly you're looking around wondering where all your hard-earned cash actually went. It's a sentiment echoing across the entire country right now.
And we're hearing the exact same pain points everywhere we look. Groceries are absolutely out of control, rent is stubbornly high, and loans are just killing your budget. When you stack food, shelter, and debt all together like that, it creates this crushing, overwhelming pressure on the average household's balance sheet.
Now, the really tough part about this is the sheer scale of the issue. Millions of Americans are struggling with rising costs right now. It's not just you. It's not an isolated incident. Everything feels overpriced because, well, it is. From the gas pump to the grocery aisle, people are genuinely feeling the squeeze every single day.
But here is the absolutely crucial thing you have to understand about why this is happening. It's not just expensive stuff. It's inflation plus high interest rates working together at the exact same time. It's this brutal dual force that's tightening the screws on the entire economy.
Let's start with the first half of that equation. Inflation. Put ultra simply, prices go up. We aren't just talking about a couple of pricey items here, but a massive, systemic trend where the baseline cost of practically all goods and services rises across the board. To see how this actually erodes your real-world purchasing power, just picture a crisp $100 bill. Because of that systemic inflation, the purchasing power of that exact same note has severely eroded. The 100 printed on the paper hasn't changed at all, but your money simply doesn't stretch nearly as far as it used to.
So, to combat this, the Federal Reserve increases interest rates to control this shrinking purchasing power, a central bank stepping in to halt spiraling prices. Sounds good, right? Like exactly what the market needs?
But here's the catch. Higher interest rates equal expensive loans, high credit card bills, and costly mortgages. Pushing those rates up directly spikes the cost of borrowing money. Suddenly, getting a loan isn't just standard practice, it becomes a premium luxury.
The harsh reality is that instead of helping instantly, it makes life harder in the short term. The long-term goal might be stability, but right now, it punishes anyone trying to finance anything. Let's say you want to buy a house.
Before these hikes, low interest meant a cheaper, manageable monthly payment. Versus now, for the exact same house, you pay way more every month. It's the exact same walls, the exact same roof, but your bill is drastically higher purely because the cost of borrowing changed.
And credit card users? They're paying record high interest right now. If you are carrying a balance from month to month, the cost of servicing that debt is compounding at a historically punishing rate. It makes it almost impossible to actually chip away at your principal balance.
This ripple effect hits businesses hard too. When borrowing costs go through the roof, businesses borrow less. And that means fewer jobs and slower growth. They aren't expanding, they aren't hiring as much, and the entire economic engine is essentially forced to pump the brakes.
So, how exactly did we get cornered here? Well, 2020. After COVID, the economy overheats. 2021, too much money, too few goods. 2022, add in global conflicts and major supply issues. And present day, boom, inflation skyrockets. It was a textbook macroeconomic perfect storm.
Faced with that reality, the government had no choice: raise rates to slow everything down. They had to pull the one big lever they have to artificially cool the economy, knowing full well the immediate short-term pain it was going to cause for everyone. We've covered the mechanics, the Fed's response, and the massive timeline of events. But the most vital question is, so what can you do? How do you actually navigate this high-cost environment and protect your own bottom line?
Here is your playbook. Step 1, spend smart. You've got to aggressively optimize your budget. Step 2, avoid unnecessary debt. Taking on new leverage right now is absolutely brutal. And step 3, invest wisely. You have to strategically put your capital to work so it outpaces that shrinking purchasing power.
The ultimate takeaway is this: the people who understand money win, and those who ignore it pay the price. So as the economy keeps shifting, you've got to ask yourself, is your money positioned to survive the squeeze, or are you just paying the price? Keep learning, stay focused, and we'll catch you on the next explainer.